All right, guys, we got him back on the show. Last time we had him on, it was a great episode. Everybody understands Grant Kemp is a monster here in Dallas-Fort Worth, Texas. But let me introduce Grant to the world. Grant has done over $80 million in owner-finance-originated mortgages. He's also closed on over 1,400 HUDs. He's a subject to owner financing, creative financing expert. He's on the show today to talk about the state of the market and what's coming, which he thinks is a huge opportunity. Welcome to the show, Grant.
Hey, man, thank you so much for having me on. I love talking to you, man. It's thanks for the intro. And just as a reciprocal intro, I hope that you guys appreciate what Connor is doing for you, because there's very few of these public personas out there that are really doing it in the background like this guy is. And so, Connor, I'm just thankful to know you, thankful to be on here and playing in a pool with big boys like you, man.
Yeah, man, appreciate it. So now the bromance is over. Let's get into how y'all can make some money. So, guys, we have another.
I wanted to play in a pool with you, huh?
Yeah, so guys, it's a little bit more about Grant. If you want to find out, we had another podcast on our other channel, Investor Army Podcast, where we really go into a lot of in-depth detail on how to do subject to type of deals, which we're going to talk about today as well. But we go into his background with Texas Pride Lending, how he sold his business and was a millionaire at 30. You're going to love that podcast. But we're going to go into a little bit of a different approach today, because the state of the market is turning and a lot of people are panicking. But myself and Grant and successful entrepreneurs in the business that understand creative financing are kind of just, licking their chops waiting for this to happen. So Grant, what do you think is going on in the market?
Dude, you hit the nail on the head, man. It's one of those things where so for the past 4 years, I have been telling people stop freaking out. Everybody's like, did you know the days on market are 14 days now instead of 3? Oh my gosh, I'm done. And everybody's flipping out over this stuff. It doesn't matter. And even when it does shift, if you know what the heck you're doing, good. Like you said a second ago, I mean, the guys that are real in this industry, we're salivating at this turn, because while everybody else is freaking out and is going to drop out, guys, this is where you make your net worth blow through the roof, is the market that we are going into. And I'm finally ready to say, we're there. I'm finally ready to be okay, we're seeing it tighten. We're seeing it shift. It's a national occurrence. This is not just people in DFW. And part of I say part of, really the biggest reason that has allowed me to take that shift and stance and say, yes, we're there. Yes, we are finally to a point where we are seeing a difference and we need to be ready for that next market cycle, is that, over this last 45 days, I've had probably 4 wholesalers that do, not just 5 or 10 deals. I mean, the minimum, actually, if we're going to go down to if I say the wholesalers that I talk to that do more than 60 a year, to a T, every single one of them is like, dude, what's going on? And I've had 4 or 5 guys that are doing 200-300 deals a year that are coming to me behind the scenes, some of which that are doing 1,000 plus a year, that I literally had to sign non-disclosures with to sit in their lawyer's office and talk to them about this, because their wholesaling market that everybody knows their name of is disappearing, and they're trying to figure out. They're like, Grant, teach me what to do in this next cycle. Teach me how the creative financing works, because we're getting now that when this stuff goes away, like it's about to, the people that only know how to do cash deals on, they're those guys. Connor, how many times have you met that guy, your carpet guy, your dude at Lowe's that's helping you in the paint department? It's like, yeah, I used to be in real estate too, and then 2008 happened, and the crash wiped me out, and here I am, right? How many times do you meet that guy?
All the time.
All the time.
Yep.
And this is the difference. Are you going to be that guy who says, oh, well, and then the market turned, and now I work at Home Depot? Or are you smart enough to be watching these podcasts by Connor Steinbrook, where he's bringing people on who can teach you what the heck to do to make more money? Because with creative financing, that is our hot market. The market that we are going into right now is the market that, if you know how to do creative financing in sub 2, you are going to be the guy that comes out with a massive net worth on the other side.
Right. So you guys, you can't win a golf tournament with one club. And that's what people have been trying to do for years. They've been a one-trick pony. The market's been exploding. Everybody can go make a low ball cash offer and find a hard money lender. When it comes to low equity types of deals, complete different ballgame, right? But what creates motivation for someone that we're used to in the regular type of business model where we're low cash offers? All sorts of different things we know about. But what creates motivation for someone to push towards a subject to type of deal or a low equity deal is being pressed with no equity in the property. Then they're going into foreclosure. There's not enough equity to sell it. There's not enough time to use an agent, and they don't really have a choice. So kind of let's talk about what you did years ago and you capitalize on this strategy, let's dig into, taking properties over subject to, because this is going to be coming back pretty aggressively. So will short sales and foreclosures. But I think a lot of people that understand the strategy are going to pick up and build a strong portfolio. And then when the market takes back off, they're going to ride that wave back up, and it's going to be a huge opportunity for them.
Yeah, I think that one of the biggest mistakes that you can make as an investor who's gotten into this arena since 2015, like Q1 of 2015, we saw a shift overnight. It went from 6 months on market to a week on market. And so if you have entered the market since 2015, you haven't seen what's about to happen, right? And what's about to happen is not the end of the world. I'm not a sky is falling guy. What's about to happen is you're going to have those sub 2 deals on your plate. And you're going to have these motivations that you're not used to dealing with, and trying to figure out how to make an offer to somebody who has that low equity in a way that makes sense to you and them is going to be very difficult. So you're going to have to watch out for back payments going up. And actually, I say going up, but ironically, fortunately, some of our back payment issues are going to be resolved in that, for the last several years, having back payments of $30,000 has not been uncommon. When we get into these harder markets, 6-month back payments are pretty common. And it makes these kinds of deals a little bit more capable for us. So what you want to be able to do is you want to be able to offer basically taking over on payments. That's not what we're going to say to our seller, because there's implications of taking over on payments, like they don't have responsibility on it anymore. And that's not true. But we can go in and make their payments on their behalf, which is the phrase that I would use. And that's where we build our portfolio. So this is what, to your point, what I did. I got in the market back in 2012, and I thank God that I got in the market in the deep section of it, because I think a mistake that a lot of the folks that have made over this last 4 years is you see guys that bought in the downturn, like you said, riding that wave, getting massively rich in this big market where we're able to kind of capitalize on all of the collections that were done. And you see it and you're like, oh, well, now's the time to get in. Now's where all the money is. And I must be wholesaling and doing these cash deals, and not really appreciating the fact that you're looking at the Super Bowl, but there was 16 weeks worth of hard work and game planning and hard hits and hard knocks that went on for 3 or 4 years in this downturn that led to that Super Bowl looking so good to you. So now we're getting back into the regular season, and it's time to take some hits, and it's time to get out there, and it's time to start buying these houses and making offers on homes that these cash buyers are not going to be able to compete with.
Right. I mean, let's kind of dig into what type of strategy we're talking about, because this is kind of new to a lot of people, or they hear about this at the REI Club. Let's show you how to get a free house, right? But they forget that it's not really free. You're coming with money to just about all these deals. But right. There's a way for you to get into properties if you're not financeable, or you're having troubles with capital issues. This is a way to kind of start building your portfolio and kind of getting into that process. Kind of let's break down what a subject to type of deal is, and then let's kind of dig into kind of how one would be put together, and kind of maybe kind of talk about how you talk to a seller, because this is not just, hey, here's your cash offer, take it or leave it. This has actual skill set involved in being able to close and turn these deals into monetized deals, because you have to build trust and rapport with that homeowner. This is not just like take it or leave it, right? It's a difference of psychology and how you're communicating with the seller, and it actually takes practice to build these skill sets, and you've done a great job at that.
No, absolutely. And I'm glad that you're drawing that to the surface, because, so I do training, if I can self-serve for a second, through creativecashflow.com. And that's a big focus, right? Like, so obviously I'm training on subject to and seller financing and what to do in a market like what's coming up. But I've got an entire module on negotiating, because negotiating is the key. Negotiating is the difference. How, do you walk up to a seller and say, hey, here's the deal. I'm going to buy your house. Okay, but we're going to put it into an LLC. I'm going to have zero liabilities on this. We're going to make you pay for it for the next couple of months while I find a buyer. When the buyer comes in, I'm going to make $4,000, $5,000, $6,000 a month. I'm going to make $4,000, $6,000 up front and $300, $400, $500 a month. And if they stop paying and we're unable to continue paying your payment, there's going to be a foreclosure that affects your record but doesn't affect my record. And that's why I'm in it, is because of the low liability and the high money that I can make on it. Sign here.
Let's do it.
Not going to happen.
That's right? Not what they say. They don't just say, let's do it right away. They don't do that.
So while that is the truth of it, right, we are buying houses with little to no liability and with infinite returns, because we're literally putting $0 in from our back pocket. and we're able to build a portfolio and a true net worth and a true retirement plan based off of this, that is the truth of it. There's different sections of truth. It's kind of like if you put a white light into a prism, it's going to break it out into multiple colors, right? Well, each one of those are the truth. Each one of those is the light. But which part of that are you going to present to your seller that makes sense to them? You have to understand where they're coming from. One of the ways that I explain negotiating is that you've got to understand worldviews that you do not agree with, but be able to discuss it with them in length and understand the principles of influence that go behind people making decisions. You've got decisions that come from your head, your heart, and your gut. People either need way too many details and they'll pull the details they need out to make their decision. People make emotional decisions and need to visualize themselves selling that house to you. Or they're going to reach that Leroy Jenkins moment where once you've fed enough of their other processing centers, they're like, screw it, let's do this. Let's close on it, right? So you have to know how to talk the game. It cannot be, here's an offer, take it or leave it. Now, that said, what is the game? How do you build that offer out? What is happening here? When we are in these markets, what you're going to run into is you're going to run into a lot of deals where they owe more than 80 or 85% of the value of the property. So of course you can't make a cash offer on it, right? So let's take some examples here. I'm going to use $100,000 of an ARV because that's a very easy thing to do in your head, brain-wise, right? So if you've got a house with $100,000 ARV and you run into a seller that owes $85,000 on it, you can't make a cash offer on that. And we're going to say this is a unicorn world where there's no repairs. Obviously I'll teach you guys how to get into all of that on another day when we've got more time, but let's just use some basic numbers. So we need to take over on a mortgage at $85,000. Well, what we run into is we run into a lot of mortgages that are originated at 3.5%, 4%. All of these interest rates that people have been getting for these last several years are going to be your interest rate if you know how to do sub 2. So we're going to come in and say, look, no other cash buyer in, name your MSA, in Seattle, in Dallas, in whatever, Cleveland, is going to be able to buy this house from you because, as you know, you owe too much. And these guys understand where they're at. They get the situation. But that's what I specialize in. I specialize in low equity deals. I specialize in deals that nobody else can buy. So you're really fortunate that you reached out to the right person. You called back the right piece of mail because I'm the person who's going to be able to help you out of this. So here's what we're going to do. I'll buy your house. Not if I buy, it's when I buy, right? I'll buy your house and I'll buy it for what you owe. And the way that this will work is that I'm going to contract it with you today. We'll go ahead and sign all the paperwork today, committing me to you, committing you to me. And then I need the next 60 days to go find somebody who's going to buy it from me. Because the market is so tight right now, and because this is not a deal, and as you know, you wouldn't be able to walk away with money from selling at retail because of the repairs and blah, 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 go into your pitch on that side. I need to be able to be sure that if I buy this house, I'm going to make money on it because this is what I'm in the business for. This is how I put food on my family's table. This is how I make a living. So we'll contract it today, and immediately tomorrow, I'll start looking for people to buy this from me. And what I'm looking for, just so you know, is I'm looking to make $100, $200 a month on this. You owe Wells Fargo $1,000. I'm going to charge somebody $1,100, $1,200 maybe to come move into this house, right? But I'm always responsible to you. You're signing the paperwork with me that says that I'm going to continue making these payments on your behalf to Wells Fargo. So you don't have to worry about what happens on that back end. If this guy stops paying, I'll get him out. I'll put somebody else new in. But I'm going to continue making payments on your behalf because your agreement is with me. I'm just explaining this situation to you so that you understand my motivation of why I would buy a house that nobody else can buy, right? So immediately, I'll start looking for that person. Here's the thing. I need 60 days to do that, but I might find that person next week. And in that case, we'll close next week. And I'll catch up all your back payments, and I'll come in, and I'll make sure that this thing is made current. And then from that point on, we're making the payments on your behalf. We're rebuilding your credit score to help you get back into a situation where you're able to go out and buy another house or finance your car or anything like that. And the goal here is that once you sign these papers, you get to kind of wipe your hands of this and not have to worry about this property anymore because that's what Grant's going to worry about. I can't take all of your problems away from you, but I can take this problem away from you. So that's how we can move forward with this, right? It's a long pitch. But you've got to kind of educate them at the same time of letting them know what your motivations are, why they should work with you, what the benefits are going to be, and then paper it up and get things moving from there.
Right. Guys, you need this offer strategy in your arsenal out there, and you're gonna mess it up the first few times. You have to kind of
Absolutely.
fail forward, because if you confuse them or they don't understand for any reason, they're never moving forward with it. So if you can't communicate this message, one of the most powerful skill sets that I think that I built over my years to be successful in business is the ability to persuade and influence people. And if you don't have that ability to do so in the marketplace, people are not going to come to the agreement or come to the conclusion with what you're coming to, that this is a great idea for both parties. And it is. What do you, because some of these people are going into foreclosure and they don't have time for retail sale and there's no equity, which would be a reason for motivation for them to sell. What are some of the big pushbacks you hear, common objections from the homeowner, and then a couple ways that you might overcome these?
Yeah, so that's a good question. And by the way, I want to clarify too. What I just gave you guys is assuming that we've already had the 2-hour conversation explaining a lot of the other things that I would explain through the negotiations and that kind of stuff. So I just want to be clear. That's not the only information they get about Sub 2. We've dived into it to let them know what's going on. That's just how I'm closing the sale. But your question, what are some objections that they might have? The biggest objection you're going to see is, what if they stop paying, right? Because I am huge on not just from an ethical standpoint, but from a self-serving standpoint. Honesty is your best policy. Just freaking tell them what you're doing. I tell these guys what I'm going to sell the house for, even with cash purchases. I tell them what the ARV is. I tell them what my rehab budget is. And the reason why my conversion rate is 88% of every house that I step into, I walk away with a contract, is because everybody else is trying to shade their crap. And they're trying to say, well, we can get this done for maybe, what do you think this house is worth, right? And I go in and I tell them what it's worth. And I tell them what I'm going to rehab it for. And I tell them how much money I'm going to make on it, right? And they appreciate that honesty. The cornerstone of this whole negotiating and getting into this is, I'm here to make money. And I could go on a whole lesson about how you should, I freaking hate, well, why are you doing this? Seller asks, why are you doing this? And then the investor out there, what do they say? Well, I love helping people. I love helping people. Freaking, you don't love helping. If you loved helping people, you'd be working for the Red Cross. You are a real estate investor because there's zeros at the end of that check. Be honest about it, okay? So when you are in front of them, you let them know, hey, I'm here to make money. This is how I put food on my family's table. And this is how I'm going to make money from your deal. Is I'm going to turn around. You owe way too much, right? That's too much for an investor to buy, but an owner-occupant who can't get a mortgage from a bank is more than happy to pay $150, $200 more a month. And if you're going to be making $400 a month, just don't name the price on that side. Just say a few $100s more, right? They would pay a few $100s more than we have to pay to Wells Fargo. So I'm going to connect the dots. I'm going to put that risk together, and then I make the money in the middle to get that going. Their question is, well, what happens if that guy stops paying? And your answer is, that should not matter to you. What's happening down there, and you heard me say this in that pitch, what's happening down the road, I'll take care of that. I'll foreclose on them and I'll get them out and I'll put somebody else in. Our agreement is between you and me, right? Now, here's the thing. When we buy this house from you, I'm going to give you something called a deed of trust. It's the same thing that you gave to your bank when you bought this house. And what that means is, if I don't do what I said I was going to do, which is continue to make these payments on your behalf, you get to take the house back from me. And so let's look at that situation for a second, okay? You're facing foreclosure right now. You're 8 months behind on payments. Next Tuesday rolls around, or next Wednesday rolls around. They're going to be knocking on your door saying it's time to get out. Now, the alternative is I come in, I catch your payments up. I immediately start making payments on time, which is going to help rebuild your credit. I'm going to fix your house up and get it up to the 2000, whatever you're in standards that we're looking at today that buyers want to see. Now, I've never had anybody have to foreclose on me. Never happened. Don't plan on it happening, but you should have the ability to foreclose on me if I don't do what I said I'm going to do. So let's look at that. Let's say 5 years from now, every one of my buyers is in Cowboy Stadium and a meteor hits it. Nobody makes their payment that month. And I just flat out can't make these payments because it's been 2 or 3 months and I can't do it. If that were to happen, because of this deed of trust that you get, you can take the house back from me. And guess what? I caught your payments up. I fixed it up. I've paid down your mortgage for the last 5 years. And I can't promise anything. We don't know what the market looks like. But in theory, real estate prices go up over a long period of time. So in 5 years, your house should be worth more and you owe less and it's fixed up and I've built your credit for the last 5 years. And now you're able to rent it out move back into it, sell it, do whatever you want with it. So here's the closing line. So here is my question to you. If your worst case scenario is better than the situation you're in right now, why would you not move forward with this? Boom. That's your hook, right? Explain it to them logically. What does this really look like? And if your worst case scenario is better than the situation you're in right now, why would you not move forward with it? And that's the moment their light bulb goes on and they're like, oh, okay, yeah, I get it.
Sounds a little bit different than the first explanation in the beginning, right, guys? Doesn't it? It's a little bit easier to make them see the benefits for them. But let's about this real quick. Due on sale clause. This is something you hear at every REI club every time someone goes to a seminar. But what about the due on sale clause? It's going to ruin my life. Everything's going to. I hear it all the time. So what's your take on this?
Okay. So first of all, let me get something out of the way. Well, let's explain what due on sale clause is. Due on sale clause is in every mortgage, and basically what it says is when a person sells their property or any interest thereof, it triggers, it's not violate, it triggers a clause that says, if you sell your property, we, the bank, have the option, not the obligation, but the option to ask for the remainder of that mortgage to be due and payable. That's the due on sale clause, okay? Again, I want to point out it's an option. Therefore, by your seller selling the property, they are triggering that option. The bank at that point in time absolutely has the right to call that mortgage due and say, hey, they owe us $80,000. So we're going to ask you to pay off that $80,000. But let me ask you this question. What does the bank want? What does the bank want?
They want to get paid. They want the payments made.
They want payments and they want interest. This was an investment for them. This is how they make their money. So as long as those payments are being made, historically speaking, the due on sale clause, we've seen, so my office in one way or another, through my partnerships, and we've seen 15,000 plus subject to deals go through. You want to guess how many due on sale clauses we've ever seen called in the last 30 years?
Probably like 5 or 7.
Yep, you're exactly right. Fewer than 10, somewhere between 5 and 7. I only know of 5. I'm assuming a couple of more have been called. You know what I mean?
That was a good guess. That he didn't tell me that before.
That was a really good guess.
No, but I mean, he had Amy Sayer on here say something similar, and we're going to push her here, but then I want to talk about what an RMLO is and how that kind of ties into this here in a second. But go on. Sorry to cut you off.
Oh, no, you're good. So the due on sale clause is very real. Absolutely can happen, okay? There are ways to kind of get out of it. Due on sale is a curative issue. It says that if the deed is not in the seller's name, then they have the option of calling the loan due. So a short story is, if the deed is in the seller's name, it fixes the issue and they will no longer call it. So that's a tip of how you can eventually go through that. The end of the story is, if you do get a due on sale clause called, it's all hands on deck. You need to be you have to disclose due on sale clause to your seller. You have to disclose due on sale clause to your buyer, letting them know if it happens. It's all hands on deck. Everybody needs to work together. But of those 5 to 7 due on sale clauses I've seen or heard of being called, none of them have led to a foreclosure or a loss of house, because all of them were able to be handled through legal help and that kind of stuff. So be sure that you've got a good attorney. Here in Texas, I really recommend Scott Horn. He's a nut. He's been doing this for 35 plus years and knows his ins and outs and can help you get that taken care of. Jeff Watson is a national guy that can help you out on that kind of stuff too. Here's what I want with them. If you are at a RIA club and somebody, or anywhere, I don't care where you're at, I'm so tired of this. Well, but so-and-so told me that if I put a property into a trust, they can't legally call the due on sale clause. Did you know how much we know about that? This is the real trick. Just put it into a trust. And it drives me crazy because that guy has a program for $9.97 that he's trying to sell you, right? Or it's some dude on Facebook that has no freaking idea what they've done, and they've done fewer than 5 deals ever. And they're like, well, I found it. You can just put it into a trust. And they can't call the due on sale clause. And it's false. The trust absolutely helps add a veil. I'm not disputing that. That is absolutely true. You put the house into a trust, it will add a veil that helps prevent the due on sale clause from being called. However, what the people are trying to capitalize on is something called the Garn-St. Germain Act that happened in the mid-'80s that essentially said if you put your house into an estate planning trust, that the bank cannot call the due on sale based on that. Connor, if I'm putting a house into a trust to avoid the due on sale clause, is that an estate planning trust?
I don't know. You tell me. I don't know.
I don't want to say the wrong thing. No, it's not. what we're doing does not fall under Garn Saint Germain. It is not a full blown, this is the solution to due on sale clause. There is no solution to due on sale clause. There are only varying levels of protection through veils and these kinds of things that you might be able to do to help yourself. But I'll put it this way. My personal house that I live in, I bought sub 2. It was a lead that came across the table. I threw it out because I don't work in houses that are over a certain ARV. But then I kind of looked at it, I was like, wait a minute, that's a really nice house. So I moved into it and bought it sub 2, walked in with $100,000 equity. The reason why I say this is that sub 2 is more than just something you can use as an investment model. Now my house, I have no personal liability on, and we walked in with $100,000 worth of equity and we love it. It's a beautiful house. I put that into a trust to help with the due on sale clause under no miscommunicated thoughts that it's a cure. It's just a veil. However, I've only done the trust thing maybe twice with investment properties because we've done 15,000 plus of these deals and we've seen fewer than 10 ever get called. The added trouble of explanation and insurance and all the stuff that goes into doing a trust instead of just flat out selling the house, I do not view as worth the effort unless you're in certain areas where like contract for deed is still available and you can do some kind of cool stuff on that to work into it. But that's getting into a rather advanced, like kind of deeper dive into it. I'm just saying, don't drink the Kool-Aid if somebody says, I've got due on sale clause figured out. It's because of a trust. It's not. It's just a veil.
Right. And these are topics in Grant's course he goes to in very deep detail. We can't do this all in a podcast, but let's talk about those deals that did get called. Do you happen to know what triggered them? Was it the insurance issue? Sometimes from what I understand, if that's done incorrectly, that can be the red flag that they know that, things have transferred over.
Yeah, typically insurance is going to be the number one reason why that gets called. And again, I go into deep detail in that on creativecashflow.com. I've even got a couple of insurance agents in to kind of talk you through what needs to be where and who needs to be named how to prevent that from happening. One of them was called because an ex-wife got pissed and she called the bank and was like, you'll never guess what Jim did. And she just wanted to ruin his credit and wanted to make his life hard, but the other ones were insurance. And then there was a bank that got purchased. It was a bank that got purchased by somebody who came in and called like 3 of the ones that I know. They came in and kind of cleaned house on loans that were out. So those are the ones that I know of that have been called and why.
Yeah, so this is an incredible strategy to add to your kind of tool bag as far as, your high equity deals, continue on flipping, buying rentals, doing what you're doing with your wholesaling. But on your low equity side, put this in your offer process. But let's talk about, do you go in first when you go into a high equity situation still? And is this the first offer you present, or do you go with a cash offer, or what do you think is the best for them? Because a lot of people think that you cannot take over a property sub 2 if there is a lot of equity because it doesn't create that motivation and they want to sell it quickly to get their cash out. But that's just not true.
Yeah, absolutely. I'm so glad that you went down that road because when you started talking about like, hey, you can still do your rentals and still do your flips and blah, 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 blah. Guys, sub 2 is an acquisition model. Okay. I'm going to repeat that. Sub 2 is an acquisition model. You don't sell sub 2. You don't buy with a wrap. You acquire with sub 2. The reason why I'm stressing that is you buy sub 2, freaking rent the place, flip the place, wrap the place, live in the place, whatever the heck you want to do on the back end, but you can get into the property by taking over on their payments, right? It's an acquisition model. So I've done a lot of flips where I acquired the property sub 2. Maybe it was a little bit lower equity of a flip. I've done a few that were high equity flips where you tell me where you're going to go get 30-year fixed rates as an investor at 3.75%. It's not going to happen. And if you can tell me that, please, God, put that in a DM and send it to me, right? It's just not going to happen. Investor rates are going to be much larger. They're going to typically be on a 15-year AM and usually have a 5-year call in it, right? So with sub 2, not only are you able to acquire with owner financing and sell with owner financing, but you can acquire sub 2 and rent that property. And now you've got a 30-year fixed rate at 3.75 that's under somebody else's name, right? And is in your LLC. So you've got no personal guarantee on it that if, worst case scenario, it did get down to a foreclosure, which again, you should never be in that situation. But if it did, it's not affecting your personal credit. It's all non-recourse lending at sub 5% rates at 20 and 30-year fixed rates, right? So it's an amazing way to build your portfolio out, low equity or high equity. And I've got some really cool ways of doing things too, where it's like, okay, let's take a deal where it's worth 100 and they owe 50 on it, but they will not accept less than 80. Okay, well, take over on the 50. Give them a $30,000 second lien where you're paying them their equity in installments. That's my pitch for them. You're willing to take your equity in installments. If you want too much cash, I'll give you too much cash. I'll buy up to 105% of the value of a property, sometimes more. But you got to be willing to take your equity in installments. And so you can create terms that make sense for you and make sense for them that your competitors just can't compete with. I'm not speaking in hyperbole when I say that 95+% of the houses I've purchased have either been told no by a cash buyer or have a cash offer on the table. But I can outcompete them because I know how to create terms that give them the numbers they're looking for and still make us the money we need.
Right. Okay, well, that's the front side of the deal. So obviously to make money in real estate, you have to buy a house, sell a house. Let's talk about the backside process. Now, assuming you've got through, come to an agreement, everything's good to go. Let's talk about what it looks like to close on the property. What are you going to do as far as an exit strategy? What is your favorite strategy? What do you think? Owner finance wraps? Are you going to turn around and rent it? Are you going to flip it? Let's talk about that. And then let's also talk about your background as an RMLO, because this plays into it. And kind of if you do an owner finance wrap, the correct way to do it, loan servicer on the back end, et cetera.
Right. So RMLO stands for Residential Mortgage Loan Originator, and it's Dodd-Frank. You should have heard of Dodd-Frank by now. It was the knee-jerk reaction to the financial crisis, and they changed a lot of how mortgage lending went down. To keep it short, I will say that everybody watching this video probably falls under something called a small creditor, which means that you have less than $2 billion in assets and you did fewer than 2,000 first lien mortgages in the previous calendar year. I'm assuming we're all in the same boat. Maybe Connor's like just almost there, but like not quite over on that, right? The two. By the way, this has nothing to do with anything.
I'm a couple thousand short.
I'm contractually obligated because I love this analogy so much to explain the difference between a million and a billion. A million seconds is 11 days. Do you know how long a billion seconds is?
I say that again. A million seconds is 11 days, so it's 11,000 days. Right?
32 years. Whatever that turns out to be in days wise. What is that? 32 times 3.
Don't ask me math questions on my show.
Oh, it's 11,600. You're right. So a million seconds is 11 days. A billion seconds is 32 years. And we're only trillions in debt. So if you did fewer than 2,000 first liens in the previous calendar year and you have less than $2 billion in assets, you are what's called a small creditor. The short story is it is very easy for you to have what's called a QM, a qualified mortgage, in Dodd-Frank's eyes. And that is what you need. When you are selling a house with owner financing, you want that stamp on your paperwork that says QM because that's how you get your court protections. QM loans essentially boil down to if somebody sues you because they're like, hey, I can't afford my payment anymore and this is America, therefore it's not my fault. I'm suing, and they sue you. You go to court and your thing has QM stamped on it. Essentially, the judge just looks at it and says, boom, I'm ruling in favor of the lender. Next. Yep. There's caveats to that. This is a much longer story, but hey, we're in a podcast, so we're not going
they have cool down periods. I mean, I had that just happen recently. It's just like people always want to point that there's no, whatever happened to people taking blame on themselves. I had a property where the guy couldn't even make like a $400 payment and somehow tried to blame me. And I'm like, look, man, just the cigarette butts on your porch here would have paid your mortgage over the past few months. I don't know what to tell you, but let's talk about on the back end. So it's important to have a loan processor handling this as far as time out of your pocket as the business owner, as well as just efficiency with tracking the numbers. And it's just good to have that barrier as well in between you and the buyer also.
Right. Absolutely. So that's when you want to employ, when you have an owner financed buyer, you want to send them to a licensed RMLO to do your application, right? So that they can make sure that you have, if you, the lender, because you're the one that makes a decision, not the RMLO. The RMLO gathers the paperwork and presents it to you for you to say yay or nay. But if you, the lender, say yay, your RMLO has made it to where you've got your Dodd-Frank compliance and you'll be protected in court. That's what you want with that. So I founded a company named Texas Pride Lending. I sold that company. Since then, several have popped up around the area or nation that can do that as well. But you need to get that done, as well as loan servicing. Who is going to actually collect the payment from your buyer and distribute it to your cash flow and the underlying lender, that kind of stuff. I recommend Note Servicing out of San Antonio, Texas. They do a really good job. They also have a portfolio of these leads or of these deals, which makes me trust them and they understand the business much more. That's why Texas Pride Lending did so well, is because I was an actual investor doing this stuff. Too many servicers, too many RMLOs have never once done a deal themselves, and therefore just don't get it, right? Don't get some of the needs of what you've got. So there's some recommendations there for you on that side. But when you buy, I mean, your question was, what's your preferred way of exit, right? What's the preferred way of exit? You've got all these options. We acquire sub two. What do? Do you sell retail? Do you rent? Do you go owner financed? And that very much is, the deal tells you the answer, right? But I will say this. There's probably a lot of you watching right now who have thought to yourself, I really want to get a rental portfolio or have a rental portfolio. Now, if you're in the second category, you already realize that that sucks. If you're in the first category, you're just almost about to realize that that sucks. Rentals are not what everybody thinks they are. They are great. I do not hate rentals. I have rentals myself. Rentals are not what everybody thinks they are. The false logic that I think has been applied is that people saw rich people had rentals and they assumed that rich people got rich off of rentals.
Right.
I'm here to tell you, nobody got rich off of rentals. You get rich and then you get rentals, okay? Now, let me ask you this. Do you have, and maybe you don't, I think I know the answer to this. Do you have a mortgage on your house?
My personal one? No.
Yeah. I know. Freaking smarty pants. Okay. So if you're watching this and you do have a mortgage or you have ever had a mortgage, I want to ask you this question. Did you ever call that mortgage company and tell them that your toilet was leaking? No.
Comment below.
Comment below. They don't care if your toilet's leaking. You pay them on the first. And if you don't, you get foreclosed on, right? So why do we think that these banks, and by the way, Bank of America and Wells Fargo, last time I read their financials, which was a long time ago, but it fits my narrative, so I kind of refuse to go back and read the financials because it might have changed since then. Like 95% of their income came from mortgage interest that was coming in, right? So why do we think that only these guys get to play that game? Why do we think that every Super Bowl ad, every rolling-eyed employee at a bank, every brick and mortar, every ATM gets paid for off of 4% interest, and we should not be looking at using that model at 9.5% interest, right? So if you become the bank by seller financing to your end buyer, nobody calls you because their toilet's leaking. Nobody moves out every year because their lease is up. You've got a 30-year commitment from that person, right? The insurance crap that happens because a hailstorm runs through, that's their problem. The owner deals with that stuff. You get paid every month, right? So I prefer, if I acquire owner financing, I sell owner financing because that is gold. That is where you build net worth. That is where you build wealth. But occasionally we might do a rental, sub two and rent, because you do get some tax benefits from rentals that you don't get from seller financing. Or it might be an area with a great, like for instance, Cedar Hill around here, South Dallas, great rental market. But there's not a lot of people that have $10,000, $20,000 to put down as a down payment. So maybe it makes more sense to rent that property over there because you've got great renters and it's going to be really hard to find somebody with a big enough down payment, And then there might be areas where the rental market sucks. There's not people with the money for a down payment, but days on market, sub 10, flip it, right? So you that's what I kind of mean by you let the deal tell you what you're going to do. My preference is to sell with owner financing because I just set myself up with some net worth gains and for long-term income with no liabilities. But then subsequently, you kind of use some logic to decide if you're going to use another exit. Does that make sense?
Right. So are you adjusting your strategy right now? Are you doing anything different with your marketing? Are you going after these deals? Are you reaching out to wholesalers to see if they pull those leads out of the trash can with no equity in them to send to you? What's a good way to get? I think we talked about that last time.
Absolutely. So a couple of things that I'm shifting right now. We're putting another September 1st. So another 2 weeks from now, I've got another 25,000 pieces of mail hitting mailboxes in addition to what we've done before. Because again, I'm not just acting like, I'm not just saying like, oh, you should get ready for this because it's going to cause you to want to go buy my course and learn how to do it. I'm saying it because you should get ready for this. I'm putting my money where my mouth is. We're upping our marketing to start eating these deals up that the cash buyers who were not smart enough to go learn how to do it are going to leave behind. That said, I've also got a big kick on JVs. If you are a wholesaler, this has been historically, and actually this might have been where you and me met, Connor. I'm not sure. I can't remember how we met, but if you're a wholesaler and you just kind of want to keep wholesaling. You kind of just know your niche and you don't want to mess around with learning this whole new thing. I will JV with you. And the way that works is obviously we need some basic information on the deal to make sure that we can, see if it is a deal. But if you just go to creativecashflow.com/JV with me, there's the information I need is right there. So just fill it out. It pops it straight into my CRM. And then somebody from my team will reach out to you to let you know what our analysis is. We do an analysis by 10 a.m. the next morning, every day of when leads come in. So you'll hear back from us by about 11:30 the next day, if not sooner. And we'll run that deal for you and split it out. And so that way you can work with somebody who knows how to close the deals. And like you said, this way you're paying for your marketing campaign out of your trash can.
Right. Yeah. We met through John Jackson. That's why you couldn't remember.
That's right. Yeah.
I'm just kidding, John. I love you, man. Actually, John's coming back on here, but
is he? John's a nut. I love that guy.
Yeah, he's hilarious, and he's also really good at lease options. What else? Anything else new you're doing right now? I mean, I think we've given them a pretty good breakdown. This process. I mean, obviously, in one podcast, it's too much information to consume, but it's a great start. And guys, I mean, think about this, Grant. All these loans coming in under 4%. When the market turns here in the next year or two, they just bought them. Right now, there's going to be no equity. They can't do anything with them. It's just going to be like going out picking. The people that know what to do are going to be able to just scoop up, really, to be honest.
Well, and I'll tell you, I mean, that's how I got into the market so for those of you who don't know my background story, like I did not grow, nobody in my family has money. Nobody in my family did real estate. I grew up in a little 1,000 square foot house with gang signs tagged on the front of it over in Garland. Like I did not have money to get into the market, but I knew I wanted to be in real estate. This was how I was able to become a millionaire within 5 years, is that I got in and I saw the opportunity to put some puzzle pieces together and say, look, this guy needs to sell his house. This guy needs to buy his house. How can we put that together and step into the middle and be a transactional coordinator that grows net worth and cash flow, right? And so this is what you do. You go in and you find problems and you solve them and you make money in the middle of it. And I argue that this is hands down the best way to do that because you get more money with less risk than any of the other strategies offered to you. So don't be distracted. Don't be discouraged if you don't have a ton of capital because like you said, you're coming in and you're getting unlimited. I came in as a 25-year-old, something like that, dude, with no money and enough money in the bank to last me maybe 6 months once I quit my job. And within that 6 months, I was consistently buying 6, 7, 8 properties a month. Okay. Tell me what bank is going to lend to a guy with $6,000 in his bank account who's never done real estate before for 6, 7, 8 houses a month. It's not going to happen.
Right.
But with Sub 2, you have that ability to get 4% financing on 30-year fixed. That's not even with a recourse. And you do that as many times as you can sit in front of a seller and tell them that it's a good idea.
Right. And I appreciate you bringing that up because a lot of people, there's this big illusion out there where wealth is created and all these rich people are like cyborgs and aliens up there. But I think I saw something the other day that said 78% of millionaires came from nothing. And wow. Multi-level marketing and real estate are how people get their business off the ground, starting out with nothing. And that's how most people create their wealth, one of those two strategies. So people need to realize that. Otherwise, they let their limiting beliefs pull them back, which is also probably a lot of what you have to teach these clients of yours when you're working with them is the belief that a homeowner will take this or the belief that they can do this. Because if people don't have belief in what they're doing, then their self-esteem holds them back from taking action. They have no energy to go take action. Everybody's like, go take action, take action. But if you go try to take action and you have no energy, it's because you have no self-confidence, no belief in what you're doing as well as yourself. And if you don't work on those sides of your personal self first, you're never going to be able to accomplish this, even if you know what to do.
Yeah, and I can't stress the wisdom behind what you just said enough because the best advice I've ever gotten in this industry is, so I was very fortunate. I mean, God opened a lot of doors for me when I got into this business. It is not normal to average 6, 7, 8 properties a month, 6 or 8 months into your career. That's not, those are results are untypical, right? You should anticipate it's going to take you 6 to 9 months to do a deal, and it's going to be 12 months before you're doing multi deals a month. And 12 to 15 months somewhere in there. So just understand, be realistic about what you're getting into. But I was very fortunate in that I got to play with some pretty high end folks and partner up with some pretty high end folks and be in their inner circle and talking to them. And when I started, consistently, people would not say yes, and it was always because of the due on sale clause. And so I sat down with one of these guys, Sean McQuistion, who he himself has probably done 5,000 plus of these deals. I mean, he was just a really sharp dude. And I sat down with him one day and I'm like, dude, everybody, how do you get past due on sale? Nobody will say yes because, and the wisdom that he gave me then has lasted with me forever. And he said, Grant, when you find that somebody on the other side of the table is consistently saying no for the same reason, it's probably a problem that you have with it and not a problem that they have with it.
Right.
And it like blew my mind. And it's exactly what you just said. And it's so true. You have to sit down and get confident with yourself. And when you can do that, that's when you can stand in front of somebody and talk the talk and get a yes.
Right. I was laughing because that's the same similar type of scenario and thought process that we see with a lot of agents in our team trying to recruit and build agent teams is they have the same type of psychology in that situation. But guys, the fastest way to become successful, what you want to do is listen to high performers that have already done what you want to do, that you know have done that you know factually. Grant brought up earlier that there's a lot of frauds out there. Let's be honest. Find people that are real in the business. You can't fake that Grant sold his business. You can't fake who he is. You can't fake that like he's the real deal. So find people that have done it and get as close to them as possible, because that's your best chance of success. Because a mentor shortcuts your path dramatically when you're trying to rise up in a new industry that you don't know.
Right. And you're going to pay for your education one way or the other. I've said before, I didn't pay for a mentor in the way of like getting a coach or anything like that. But I only got 30% of every deal that I did for my first few years. And it only went up to 60%. And I just ended that partnership a year and a half ago. Right. So I paid millions of dollars for the education that I got through partnerships. And it made sense because it was like, hey, he brought the money and the knowledge. I brought the time and the effort. And then we kind of, we kind of shifted that to where I had the money and the knowledge. And that's when it made sense to kind of split that out. So especially in a topic like this, where you really need to do things the right way. You really need to make sure that you are, because guys, there's a million times more turning gears on sub 2 and owner financing than there is wholesaling and fix and flips. Just hands down. It is the most complicated strategy there is out there, but it's rewarded with the massive benefits that you get from it, right? So it's worth that. So I know like guys like Corey Thompson, they're like, screw the guru, never pay for somebody unless it's subject to an owner financing and you're trying to figure that out, because there just are too many pitfalls for you to fall down. So again, you're going to have to pay for that through a partnership or through an education or whatever. But be aware of that, because you can get some pitfalls. And the guys, by the way, you're talking about a lot of frauds. Guys putting their pictures of a check up on Facebook, come on, and until I see the P&L, there's so many fake dudes on there. So just be very careful who you align yourself with, both ethically and morally, how they run their business, and really do your research on, do enough people vouch for this person that you're going to work with. I'm not the only guy that knows how to do this stuff. There's lots of guys. Mitch Stephen is amazing at this. Eddie Speed knows how to do notes like nobody's business. Scott Horn is who I learned it all from. Sean McQuinn. There's all these guys that know how to do it. I'm not just sitting here saying like, don't go to any of them, only pay me. There's millions of guys that can teach you how to do this stuff, but be very sure who you're working with before you get on board.
Right. You see those checks, $200,000 check, $199,000 was their cash in the deal. It's like, but people don't know and they get tricked into it. It's unfortunate. And also to bring up what you're talking about, the reason that it is a little bit more difficult and there are more working parts and there's less people doing it, that is the entire reason you should be doing it.
Oh yeah.
Most people follow the path of least resistance, which is going to a very easy strategy, like a wholesaling strategy, where all they have to know is, hey, here's your cash offer, take it or leave it. And that's why they're having results similar to everybody else, where it's tough because everybody's fishing in the same pond. Do you want to fish in a pond where there's 100 people fishing and there's only a few fish, or do you want to fish in the pond where you're by yourself and you're the only one there? And that's why this is going to give you a huge edge going forward. If you do take the time to discipline yourself and study this information and gain this knowledge, and once you have it, no one's taking it from you. And then it's just something that's going to be an extra income stream for you. Though a lot of you are losing a lot of money not being able to capitalize on deals. And Mitch Stephen was on here podcast last week. Mitch, a good friend of mine, talking about different types of creative financing with owner financing. And I actually have a video on my podcast that I learned how to do that type of strategy, create a note, sell a note from Mitch. And I made almost $30,000 on a house that over 20 wholesalers had been in, including some of the biggest wholesalers in DFW had already had that house under contract and nobody could sell it. And it took this type of strategy to be able to make money on it, not just a little bit, but a very good deal. And that's why if you do have to take a little bit of time and to figure it out, it's worth it because you're going to get paid back many times over exponentially over the years.
Absolutely true. And you're not going to get knocked out of the market over this next 3 or 4. This next 3 or 4 years, honestly, if you start working on it now, this next 3 or 4 years is where you make your retirement. I mean, it really is. This is the market you buy in. This is where you can be done. If you do this the right way over the next 3 or 4 years, you can be done.
Right. Grant, you're always one of my favorite guests. Let's send people to how they can find you. What's the best types of platforms to send them to? How do they get to your course? We'll probably put a link below here. How do they get to, you're still doing a lot with Propelio, I think, over there in the studio?
Yeah. So every week I do a show at 11 a.m. on Propelio's Facebook, Facebook and YouTube. So youtube.com/Propelio. And then if you want to learn more from me, I do a weekly Q&A every Monday night where I go through all these things. I've got a very extensive online course that just, there is no comparison. I've got hubris on that because I feel like I can back it up. There just is nobody else who's going to get you that kind of knowledge on how to do sub 2 and owner financing. That's through creativecashflow.com. And then we do have like a high end, if you really want to dive in, I've got some guys that take their business very seriously. And in that case, I've got a mastermind that meets every quarter. And if you're in that mastermind, every Thursday, we meet and we do a deal analysis workshop where I will chop up your deals for you and show you. I mean, last week was a perfect example. One of my students came in, and what'll happen is, like, if anybody has a deal, I'll chop it up for them. And if they don't, I'll present one of my deals and I'll chop it up and show you how that was made. And the guy, I'm asking, he's like, no, I don't have anything. I mean, I've got some crap. It's not even worth talking about. And I was like, no, I mean, tell me, if you've got a lead, let's look at it. And he's like, it's not going to make. He really didn't want to show it because it was such a terrible lead. Well, at the end of the day, I turned that lead into $2,000 up front and $250 a month for the next 20 years. And then it goes up to $800 a month after that, right? It took some finagling, took some crazy chopping, but this deal that he was so ready to just throw away, that's money. That's real money. That's $2,500 a year, right? So that's my higher end group. That's the CCF executives, which is the mastermind and the deal analysis workshop and that kind of stuff. So I would love to get to know you guys. But watch me on the, like I said, Propelio or Facebook, youtube.com/Propelio. There's a whole block of videos called Grant Teach Me Something. And if you want to get involved in my inner circle and you want me to be working with you individually to make sure that your business is not going to fall away over this next year or so of transition, check it out at creativecashflow.com.
Right. And this is open up to everybody in the country, right? Not just here in Dallas.
Yeah, absolutely. This is a national strategy. This is not, I'm based out of Texas, so I'm going to talk Texas law because that's what I know best. But, look, I've sat in rooms and talked with the congressmen and senators in Washington about these things, right? We have moved the needle in Austin about law here. So I understand national law. I understand local law. 99% of the stuff that's going on with this stuff is national. There's a few little tweaks you do per state here and there. But the majority of everything that you will ever need to know is going to be on creativecashflow.com. And like you should always have, consult your state local attorneys on anything that you're doing. Right. Awesome. Grant, appreciate you. And guys, go check out his YouTube channel, subscribe to it, like, share, and comment below. Subscribe to this one as well. And we'll see you on the next one, guys. See ya. Have a good day.